presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Market Update YouTube update for October the 4th, 2022. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. I'm going to talk about the Fed, what has happened to interest rates this week. The market, boy, last couple of days have been great. Last week was terrible. The economy, the technical analysis, looking at the market, it doesn't look all that good. The recession is still a probability. And does anything change because of the 2 days of 5.5% jump that we've seen in the market over the last couple of days? Does that change anything? We'll talk about that, and I'll give you an update on looking at the week ahead. So let's start with the Fed this week. If you look at the interest rate increase this cycle, it has been dramatically tighter. Even when the Fed did it and Volcker did it in the 80s, it was not as steep and as quick as what we have seen. Now the question is, will the Fed raise another 75 basis points or 50 on November 2nd? Market expectation is, and what the Fed has been saying, they're going to do 75 basis point. Market expectation has dropped down to 60% probability that we are going to get 75, and the 40% probability that we are going to get somewhere around 50 basis points or 0.5% increase in interest rates. Today we did get the number of jobs openings. They've dropped by 1 million, but from 11 down to 10 million. We still have 10 million jobs available. We did get some of the manufacturing data that shows some slowing in the economy. And that brought interest rates, which hit 4% last week for the Fed for the 10-year. Dramatic drop in rates back down to 3.6 for the 10-year. But it is a short-term decline. I still feel that by the end of this year, rates could be higher. And if they are higher, then we've got more pain to come as far as the market is concerned and the economy is concerned. Looking at how much the Fed's usually historically, you can see that this is the projected rate of interest rates, the orange, and the blue is where the rates went to last time. You can see that what the market expected and where the market peaked, interest rate peaked in reality, is always lower than where the market thinks it's going to go. As you've heard me say on the daily broadcast, on the radio, market always overshoots to the upside and to the downside. Just like in June, everybody thought, okay, the inflation has peaked, the Fed is going to take or lighten the pressure on the brake, or they're going to raise interest rates less now. But then we found, again, when we got to August, found out the Fed came out and said, no, we're going to continue to raise rates, and the market had to readjust, and consequently we saw the decline in August and September. Now the market is saying, well, we're going to see rates going straight up. Maybe not. We saw the Bank of the Australian Central Bank came out and raised interest rates only 25 basis points last night instead of 50. We saw Europe, or especially the UK, reverse its policy where they were going to do QT, then they were going to do QE, they were going to do cut taxes. Now they're not going to cut taxes. So the banks are sort of starting to realize that they just can't do anything they want to. But you can see that every time where the rates were expected to go and where the rates peaked, there's always a gap. Now this is the expectation where the rates are going to go. This is where the rates are. Yes, I think we can get up to about 4%, but the market now is expecting 4.5%. Are we going to get there? We'll have to wait and see. I still think there's a chance. If we do see inflation coming down, if we do see the economy slowing down, that the Fed might slow down the rate of increase in interest rates. Not that they're going to stop. Now, other people are going to say, well, the Fed is going to stop raising rates. They're going to start bringing rates down. I think the rates are going to stay at this elevated level for a period of time, but the rate of increase in interest rates could slow down depending on inflation and depending on what happens. Looking at the markets, you can see the implied probability of a recession has gone up to 67%. Small cap is saying, yes, there is a recession. Large cap, 80% probability. Commodity index, 70%. And credit specs, they haven't got that bad, but they could overall. Treasury yields have climbed back towards 4%. Again, we hit 4 last week. We're down to 3.6 today. I think this was wave 3. We're going to see wave 4 and then another move to the upside. I'll talk about that when I take a look at the charts. You can see what has happened to the market when we see a 20% drop in the S&P. The following year, you can see that in 1937, market dropped 38%. The following year, it was up 24.5%. 1974, dropped 30%. Following year, up 31%. In 2002, it dropped 23%. Following year, up 26%. 2008 dropped 38.5%. Following year, 23%. Now, you can see all of these numbers except this one is higher, the decline, than what we've seen this year. So another 4 or 5% on the downside from the bottom. We could see down to a 30% drop, and that'll put us in some of the worst recessions in the market over the last 20 years or 30 years or so. So if we do see those kind of declines, from there usually the market does snap back up. Looking at the economy, we're see a drawdown in the amount of liquid cash that people have available. It is starting to come down. All the savings that people had, the money that was not spent during COVID, is being spent now, and the saving rate is starting to drop. And as that drops, we are going to see consumption come down also. Mortgage rates hit 6.7%. We've not seen that rate in 15 years or so. So that'll slow down the housing market. People who still want to buy a house might not be able to afford it because the payments have gone up so much. Don't forget the Daily Show. You can download the app. All you have to do is go to the App Store, the Apple App Store, and download. Just type in Market Wrap with Mo Ansari. One word, Market Wrap with Mo Ansari, and from there you'll get the free app, and you can get the daily edition of Market Wrap, which is a 1-hour edition. I talk about the markets and some great guests. Looking at the technicals, again, as I mentioned, everything moves in 5 waves. This was wave up in the interest rates, wave down, wave 3 up in rates, wave 4 was down right here, and then we saw a 5th wave peak in rates. This was in June. As soon as the rates peaked and started to come down, the stock market took off to the upside. And then we saw what is called an A, B, C correction, and that's what we saw after a 5th wave. Now you saw wave 1, wave 2. This was wave 3. This was my target, or right around 4%. We hit it. Now we come back to the 20-day moving average. That's wave 4. And then we see wave 5 taking us up to about somewhere around 4.25%. So as rates go up, that will put some more pressure on the stock market. Looking at the S&P 500, again, we saw wave 1 to the downside, 2 up, 3 down, 4 up. This is showing wave 5, but the wave 5 target is right here, somewhere down here. That brings us down to about 33.5 to 3,400. We only hit 35.85 as a low last week. Now we're bouncing up. We went exactly 37.99 is the 20-day moving average. We hit that today with a high of 37.91 was the high today. I think we could see another decline here to the downside if we don't get it. If we can get above here, a resistance around 3,900 and then 4,000. But we need to get above 4,000 before I get excited about the market that we have made a bottom. We're not quite there yet. Looking same thing on the weekly charts, 5th wave top, ABC correction. This is A, this is B, and this is C. Looks like we've completed that, but we've got a long ways to go. 39.5 is the number right here that we need to get above, 39.50, and we are only at 3,800 today, or 37. So we need to get above 39.50 to get excited. NASDAQ, again, wave 1 to the downside, 2 up, 3 down. You're seeing 4th up, but here's the 20-day moving average, 11,250, closed at 11,176 today. We need to get above 250, then maybe 12,000 to get excited that we have made a bottom. If not, we're still looking at about 10,000. On the weekly charts, it looks better. It looks like 11,175 is the resistance. We closed 11,176 today, slightly above it, but we're right there at the 200-week moving average. We need to break above here, come back up to about 11,800 to 12,000, and that's the number I'm looking at. That will. And the dot plot, as you can see, the dots are above the market. The market is here. The dots are here. We need these dots to come below the market before we see the long-term trend that turn up. So that's why I think this is more of a bounce that we're seeing. But it all depends. If inflation starts to weaken, if the economy starts to weaken, and the market gets a hint that the Fed is going to not raise interest rates as fast, that could be very good. Crude oil bounced off the lows on expectation that the OPEC is going to cut production by about 1 million barrels, somewhere between 1 million to 2 million. But if they even cut by 1 million, that will give the market a psychological boost. It did get a big bounce up. We're going towards the 50-day moving average, the blue line right here at 88.50. We closed at 86.37 today. So we're going towards there. But if the economy is slow around the world, which Europe is slowing, China is slowing, US is slowing, I think the demand for oil is going to continue to go down. Gold, the target was 16.15. We hit 16.22 this low last week. That was my target on the downside. Looks like we completed 5 waves to the downside. Wave 1 to the downside, 2 up, 3 down, 4 up, and this is the 5th wave to the downside. Completed 5 waves. Once you complete 5 waves, then we get a bounce to the upside. We're back up to the 50-day moving average, which is 1736. Closed today at 1735. So very close to that. If we can get above 36, probably 1828 is the number. That's the technical picture that I'm looking at. Nice couple of days in the market, but I want to see a lot more follow through depending on the unemployment numbers come out and how the inflation numbers come out. Plus, we've got to see earnings, how they come out later on this month. In the middle of this month, we start getting earnings for the last quarter. More important will be guidance. What are the companies saying about how much profit they can make in the future? What are the sales looking like for them? That will be a big indication to me. I think the market was looking at rose-colored glasses in June. Oh my God, the Fed has stopped. The market is going to take off. Now the same thing. They've been looking at earnings reports and saying earnings are continuing to hold steady. I think as the economy slows, earnings could come down. And if earnings comes down, that could bring the market down. But again, if you have the right allocation, you have the right mix of assets, you're down 10, 12% or so, you're okay. That's part of life. That's part of being in the market. And if the market turns back up, you will be okay. But if you had the go-go stocks and you're down 60, 70%, you've got a problem. Now you're holding hoper where you're holding and hoping one day you'll break even. Come to my seminars. Next seminar is going to be this Saturday in Orange County. The next Tuesday night, I will be in Scottsdale. So if you want to come to a seminar, I'll talk about all of this in a lot more detail and answer your questions. If you want help from us, we will be more than happy to guide you, set up a portfolio for you, show you what we do and how we do it. All you have to do is make an appointment and come by the office. Looking at the market, it's about 50 to 60% probability, I would say, that we're headed to a recession. Again, don't forget, if you'd like to get my weekly newsletter, just click on the link below. Looking at the week ahead, again, the unemployment rate this Friday is going to be a big data point that we'll have to wait and see. Again, thank you for tuning in. I'm Mo Ansari. I will be back with you at the same time next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.